The ETF industry had a record year, close to $1.5 trillion of net inflows if you round up slightly. Small caps was the rare investment style to actually incur net redemptions. There was about $7 billion for the full year for small cap ETFs.
All right, joining me will be Cullen Roche, founder and chief investment officer of Discipline Funds, who's an independent investment firm that back in November, they rolled out a suite of what are called Defined Duration ETFs. There are currently 3 of these ETFs in all. And in a nutshell, these are seeking to match the underlying investment approach in the ETF with real world financial planning needs. So Cullen calls these time-weighted asset liability matching ETFs. These cover 5, 10, and 20-year time horizons. And I would say to think about it like this. Obviously, saving for a kid's college in 5 or 10 years is different than saving for retirement in 20 years. And these ETFs seek to account for that via their asset allocation. And then not only that, if you actually dive further into the approach here, a key aspect is controlling for both stock and bond duration risk. So in general, these ETFs will hold less equity exposure when stock valuations are elevated, and then they'll shorten bond duration when interest rate risk is elevated. The overall idea is to reduce sequence of return risk. I think this is a pretty unique approach, and so we're going to walk through these ETFs in pretty good detail. And then the other topic of conversation with Cullen this week, which I'm very excited about, I'm sure he's even more excited than I am, is Cullen is out with a brand new book today. It's titled Your Perfect Portfolio, The Ultimate Guide to Using the World's Most Powerful Investing Strategies. And I'll tell you, I had an opportunity to read this over the weekend. Really enjoyed it. It's an excellent read, and you're going to get a nice preview of that as well. Now, to start this week, to help me kick off yet another year on ETF Prime, I'll be joined by the one and only Todd Rosenbluth, head of research at VettaFi, who has provided me with the 5 ETF stories he's most focused on as 2026 gets underway. And I think you'll find these interesting. I would say these tie into both some broader investment themes in the markets, and then there are also a couple of more industry-oriented topics as well. Plus, Todd is going to look ahead to the upcoming Exchange Conference in March. That'll be held in Las Vegas, which I'll obviously be attending that. And that's only a little more than 2 months away. So if you haven't made your plans for that yet, it's probably time to get on that. And Todd will tell you why you need to be there if you're still on the fence. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in VettaFi's Todd Rosenbluth. Todd, Happy New Year to you. Very excited to have you kick off what should be another great year on ETF Prime.
Happy New Year. Thanks for the partnership. Thanks for the education. I'm going to gloss past the fact that you didn't need to watch NFL football since your Chiefs were already out of it, so you had a chance to read a book. And let's just talk about what a great year it was and what a great year it's going to be for ETFs.
I like that. I'm going to skip over what you just said as well, and we're going to get right into ETFs in 2026. And as I mentioned, you did provide me with 5 topics you're most focused on as the year gets underway here. And let's just go through these one at a time. You can explain the rationale for each. And as usual, we can bat these around a little bit. And the first one, I'm definitely interested to hear your take on, and it has to do with small cap ETFs. You're watching whether there will be what you call persistent demand here after, I would say, yet another lackluster showing last year. So walk us through this one.
Yeah, so let's set the stage. The ETF industry had a record year, close to $1.5 trillion of net inflows if you round up slightly. Small caps was the rare investment style to actually incur net redemptions. There was about $7 billion for the full year for small cap ETFs, although they did see a burst of demand in the fourth quarter, in particular in December. Now, small caps underperformed the S&P 500. The S&P 600 rose, I think, 6% for the year. That lagged the S&P 500, the large cap version of the S&P index, by more than 1,000 basis points. But the gap narrowed in the fourth quarter with just roughly about 100 basis points between the 500 large cap and the 600 small cap. Lower interest rates help and should help because smaller companies tend to be more likely to be indebted and need the cash where they can get their hands on. So I'm watching whether or not we see renewed interest in small caps or continued interest in that we saw a burst in December. But the two leading small cap ETFs are IWM and IJR. That's the Russell 2000 ETF from iShares and the S&P Small Cap 600 ETF, also from iShares. Combined, they had something like $7 billion. That's most of the money that we saw of the outflows. So I want to see if we see overall interest in small caps, if they pick up now that we've got lower rates and maybe even lower rates. And many people talk coming into the new year that they're going to have dispersion. We're not going to be led by the mega cap stocks again. So if that's the case, let's see if those small cap ETFs are in demand. Let me pause.
Yeah, I don't know that I have anything really enlightening to say here other than I think this one simply comes down to returns, which you touched on. And if we use IWM as a proxy, the iShares Russell 2000 ETF, that was up 13% last year versus 18% for the S&P 500. But like you said, that gap narrowed a little bit, down the stretch. But, Todd, if you go back and look at the past 5 years, those numbers are about 37% for IWM and 98% for the S&P 500. Now, I should mention there are some small cap ETFs that have come close to matching the S&P 500 over the past 5 years. So an easy one to point to would be something like the Avantis US Small Cap Value ETF, ticker AVUV. But, that still underperformed last year. And so where I'm heading is, I think, particularly for financial advisors, this is going to be a performance story. I think if we see sustained outperformance, then certainly advisors will look to allocating here. And your point on diversification, that continues to be a talking point. We continue to hear about the concentration in the S&P 500 and perhaps the need to diversify outside of that. But the proof is going to be in the returns here.
So just a quick comment on your comment. Yeah, we've seen benefits of an active approach to small cap that uses quality, or even an index-based approach that takes quality into account. So you mentioned Avantis. Dimensional Funds also offers some small cap active products. There's the Victory Shares Small Cap Free Cash Flow ETF, SFLO, SFLO, that had a better year than the Russell 2000 did. It takes a quality screen of some of those smaller cap companies. So yeah, there's lots of different ways to slice small cap. I'm going to be watching this. Again, this is not a call that small caps are going to outgather or outperform. I made that bet. You didn't mention it, so I'll mention it because Eric Balchunas has not reached out to me. I owe him a steak. I owe him a steak dinner or lunch, whichever one he chooses. I put my money where my mouth was for performance. That's not what this is for 2026. This is what I'm watching in terms of flows.
The only other thing that I'll add here on small caps, and this is something I believe you and I talked about last year, but I think it bears mentioning here, is just there has been a lot of talk over whether, since companies are staying private longer, that perhaps that's hurting the performance of small caps, right? There's been a lot of M&A with these mega cap companies scooping up smaller companies, and that'll obviously provide an initial return pop to that small company if it's in an index, but not a lasting one. And I do wonder if there's something there. I haven't crawled into all the academic research here. There are people far smarter than me who can do that, or maybe they have done it. But I do think that's something to consider as well.
Yeah, again, I haven't dug into it either. But as far as I know, the Russell 2000 still has 2,000 stocks in it, the same way it did when you and I entered the ETF industry. So the fact that there's 2,000 companies that can be inside the ETF that are available, I don't think we're struggling to find, or they are struggling to find companies. Are they the right companies to invest in? That's perhaps a different argument, but the same thing could be said of there aren't enough S&P 500 companies because companies are staying private also and just not going public. So I'd rather move on to the next thing I'm watching than debate whether or not we've got enough companies.
All right, let's do that. So the next ETF topic you're watching for in 2026 is whether AI, artificial intelligence, will be the dominant theme again. And then if so, which ETFs might benefit? And I agree with you on this one. I think most investors are at a minimum keeping an eye on AI. And I think there are some who are obviously still very bullish on this space. I do think there are some others that believe the space might be a bit overbaked when you talk about valuations and just how hard things have run here. But what are you watching for?
So again, maybe let's set the stage. I just saw State Street Investment Management put out its flows report, and so I'm using their data as the reference point. $16 billion of money flowed into the category that includes artificial intelligence. That's more than half of the money that went into overall thematic ETFs. So this is, again, an area of focus. In particular, ETFs that have AI in the name. The iShares AI Innovation and Tech Active ETF, BAI. I think it gathered close to $8 billion of new money in 2025. IVES, IVES, which is the Dan Ives Wedbush AI Revolution ETF, launched in June, and I think it crossed $1 billion and then just fell below it and is approaching it again. So AI investments were in high demand. So I'm watching to see if that will continue, if the named ETFs that have AI do well, but also the tangential or related ones. So I think we are the index provider behind the Range Nuclear Renaissance Index ETF and UKZ Nukes. That ETF was up 55%. That outperformed the ETFs that have AI in the name, nearly double the case for some of those, because there's demand for data centers and AI infrastructure coming online. What I'm actually looking for is, do we see something like nukes, but do we see another sub theme perhaps come into it? And so ROBO, that's another ETF that we are the index provider behind, the Robo Global Robotics and Automation Index ETF. Now that ETF gained 22% from a performance standpoint in 2025. It performed well. The stocks performed well. I'm wondering if we're going to see in 2026 the connection behind the robot as a physical body to artificial intelligence as the mind. And we at VettaFi, that's something that our research team is focusing on. I'm keeping my eye on. Do we see other themes like robotics come into more of a play?
I like that. I think that's a good take. And I would just say that if you are bullish on AI or robotics, and I think you're going to love this, Todd. I just think it's important to look at ETFs with minimal overlap to the larger market cap weighted indices, right? Because those are obviously loaded up on exposure to AI, but it's different exposure. It's the NVIDIAs and Googles and Microsofts. And so to your point, there's going to be these tangential plays on AI that may come out, and you just want to make sure if you're playing those that exposure looks different than what's in the larger indexes. So I agree, this will continue to be a theme to watch. I like that one. I want to move on to this next topic that you're watching for this year. This one stood out to me, and that's whether high yield ETFs will gain traction despite historically tight credit spreads, which I've talked a lot about on the podcast. So tell me more about this one.
Yeah. So again, let's set the stage. Record flows for fixed income ETFs, over 400, I think it was close to $440 billion of new money went into fixed income ETFs. We did see demand for high yield ETFs throughout the year, and as people were willing to take on risk, but nowhere near to the degree I think that the spreads would warrant because and the strong performance would warrant. So HYG and USHY, those are the two largest of those high yield bond ETFs. We're up close to 9% for the year, outperforming the ag. So you got rewarded for taking on risk. But as you mentioned, spreads are extremely tight. So I think you actually talked with my colleague, Cynthia Murphy, your last podcast of the year, using some advisor sentiment data. And I'm glad she didn't actually share with you the one that I wanted to share with you. But 38% of advisors told us during that event, or one of our late events in 2026, that high yield corporate bonds still looked relatively attractive to them. Now, we gave them 6 or 7 different fixed income categories. So high yield was actually the number 2 choice for people. So I'm intrigued to see if people put their money where their potential sentiment was and put money into high yield ETFs. HYG saw inflows in December. That's the more institutionally oriented product. USHY did not see inflows. That tends to be the lower cost retail oriented product. So I'm intrigued to be able to see whether or not we see high yield is where people take on risk in fixed income, or are they more likely to hunker down into the lower risk treasury products, or even just the ag as they get lower returns and lower yields.
My simple take on that, and to be very clear, this is not investment advice. Um, Todd, I don't like the risk reward dynamics in high yield right now because you have historically tight credit spreads. I feel I've talked a lot about this on the duration side, that if you look at longer duration, even treasury bond ETFs, that risk reward, while I think it's gotten better, it's still not overly attractive to me. In the high yield space, if you look at the volatility profile of a lot of the high yield products, they look very similar to equities. And I just wonder if, maybe I'm not making a call on the US stock market either, but I think you could make a case after 3 years of unbelievable returns from the S&P 500, maybe we have a little bit more of a turbulent year this year, or things pull back a little bit. Perhaps the economy slows down a little bit. I just don't know that high yield is where I want to be taking risk. Now, I will say there are some very interesting ETFs, which you're well aware of, where they're more broadly diversified. And so you're getting some exposure to high yield via those products. I think that makes some sense if you want to try to scratch out some additional yield. But just allocating directly to high yield, it gives me a little bit of pause. But that's why you watching the story was intriguing to me, because and the survey data you just mentioned is very intriguing to me as well. Clearly, if you look at returns last year, the 9% you mentioned, that's attractive, especially when you have yields coming down right now, at least on the short end. So I'm throwing out a lot here, but that's why I think this is an interesting story to watch.
So agreed. And just so that I get my disclaimer out there, I'm not offering investment advice. We've gone through three things, say that twice, three things, I guess a third time, that I'm watching. And those all appear to be risk on. So small caps would be a risk on. High yield would certainly be a risk on. AI continuing to stay in favor is a risk on. I'm not making the case that that's going to happen. That's what I'm watching to see. Those are three areas. I don't know how interesting it would be if I told you that short-term treasury bond ETFs were going to be the most popular thing. Maybe they are. I guess that's something to watch too. But I'm intrigued by the car race that might be going on in this record industry as opposed to the stop and go.
Okay, so those first three stories, as you noted, those are all more investment related. Let's look at the other two stories you're watching, which I would say are much more industry related. And the first one, which is not going to surprise anybody, is the multi-share class structure. And very clear, this is going to be a huge story this year to watch. Are you more interested to see how aggressive asset managers are here, or are you more interested in what investor interest looks like as these share classes start coming to market? Is it both? Like, what are you thinking on this one?
So I'm more interested in watching what the firms do before we get to see what investors do, because we need products. We need to have an ETF share class of a mutual fund that needs to be available on a platform for an advisor to invest in, or to be set up for a retail investor to convert their mutual fund share class into ETFs. And so, one of your last guests of the year was Ben Johnson. I really enjoyed listening to that. He does an excellent job of tracking what's going on here. I'm using his LinkedIn post that I saw in late December that it was over 30 firms that have taken that next logical step. That includes some of the heavyweights within the ETF industry. So Dimensional Funds, which is helping to lead the charge, and BlackRock and JP Morgan. But it also includes some firms that are newer to the ETF marketplace, Barron Capital and Tweedy Brown. And so I'm intrigued to see how these established firms, as well as these newer entrants into the ETF marketplace, what they bring to market, how they bring it to market, what becomes available. And then we'll see if there is advisor investor demand. But right now, the approval to do something is not the same thing as doing it. And so I think we're in the stage of waiting to see what happens. And I very much expect that we're going to have products out by the end of the first quarter. I know we're going to talk more about the exchange conference in a little bit, but I expect we'll be hearing about those products both on stage and off stage at the exchange conference. But I'm intrigued to see at what pace.
Todd, you and I are going to have to be fully locked in this year, tracking these things coming to market. So you know I'm going to have to work in crypto ETFs here, which you'll see where I'm coming from. There's something like 130 crypto ETF filings out there. Those are going to be coming to market. We're going to have, as of right now, those 30 plus asset managers who are approved for the ETF share class structure. I believe there are 90 or so asset managers who have filed with the SEC for the structure overall. So just think about the product coming to market. I bring up crypto because I love covering the crypto space. So I'm going to be tracking those. And at the same time, we're going to have to keep tabs on this what I think will be a flood of share classes, ETF share classes coming to market. It's going to be, again, you better be on your game this year.
Listen, this is the ETF Pundit Job Security Act of 20 whatever year that we're going to be in, getting renewed again. Product development isn't slowing down. The ETF industry isn't slowing down. Record pace of flows, record volume, record launches. I think perhaps a high number of closures. Also, this is what's healthy and what makes it fun. I'm excited to continue to follow this with you. But I think I've got one more thing that I'm watching before you tag me out.
All right, so let's just talk about that now. You're watching this Goldman Sachs innovator deal that's expected to close in the second quarter, which $2 billion deal, by the way, which I still think that's an enormous number. Great deal for innovator. But you said you're interested to see what innovator ETF flows look like prior to this deal closing, and then how Goldman ultimately integrates innovator's ETF lineup. So do you think this ends up being a good deal for Goldman?
So I do so I'm not going to deal with the profitability. Is this good for Goldman stock? I took my stock hat and put it off to the side more than a decade ago. As an ETF entrant or the way to expand their ETF capabilities, I think this is a great opportunity for Goldman Sachs. They've had success with some options-based products to a small degree. They've got GPIC, GPIQ, and GPIX. I guess GPICs, I should say out loud, even though that wasn't clear of the distinction. Both of those had strong flows in 2025, and in particular, during the deal, after the deal was announced in December, they had strong flows. Whereas Innovator, I'm intrigued, as you mentioned, to see what happens heading into the deal. These are, the people, the business and the people are being acquired. So what happens heading into the deal? How aggressive are they in educating and raising awareness about their products, that being Innovator? You always want to see what happens. I think that the competition is out there and telling a story relative to Innovator. They certainly should be. This is an opportunity for them to potentially win some business. So I'm intrigued to be able to watch that. But I think Goldman is going to be able to leverage the capabilities of the brand, the range of different products. And I think it's going to be a success for the Goldman team. But it's something I'm going to be watching because an acquisition is not 1 + 1 = 2. It can be 1 + 1 = 3, or it can be 1 + 1 = 1.5. I probably should have used the larger numbers there for my example, but I think you get my point.
Yeah, the two big factors here, in my opinion, and I think these are the obvious factors, one of which you touched on with Goldman's capabilities, is Goldman has massive distribution. And I know I'm a broken record here. Distribution is king in the ETF space. Goldman has an army of wealth managers. And so they have a very easy distribution channel for these innovator products. And the second factor would be if you combine that, and again, I don't want to give people the impression I'm bearish heading into 2026. I'm not. But if we do have a more volatile market environment, and maybe we do get a pullback after 3 spectacular years, I think that's going to have investors looking more to the defined outcome ETF space. And so Goldman's distribution isn't going anywhere. If you add to that perhaps a rockier market environment, I think that could be a perfect combination for Goldman, and this deal will end up looking spectacular. Now, if the S&P just keeps racing ahead and we get another 20, 25% year, and we just keep moving forward like that, I think it's going to be a little bit more difficult, only because this space is going to continue to get more competitive. You may recall I mentioned towards the end of last year, Aptus launched some buffer ETFs at, if I recall correctly, like 25 basis points. That I think you're going to see more issuers come into this category. There are already a lot that are playing in the defined outcome ETF space, BlackRock, so on and so forth. So I think there's a lot of competitive pressure here as well. And I think that would be sort of the negative side to this deal. Are they buying it, quote unquote, the top of the buffer ETF category?
Yeah, I guess just a quick comment there. Innovators had a tremendous success, and the broader category of defined outcome, downside protection, and enhanced income or premium income, or whatever we want to call it, depending upon each of the individual products, has had a tremendous last 3 years, and that's with the S&P 500 being up close to 20% 3 years in a row. So I think if we do see some volatility, that's a great opportunity. Even if we don't, I think people are going to anticipate that volatility and want to protect themselves, and might be comfortable with a year where they make only 10% in a market that goes up 15 but has some volatility.
Yeah. So again, that deal closes, or it's supposed to close in the second quarter. So I agree. I'll be watching that as well. Okay. Before I let you go here, as I noted at the top, the Exchange Conference, that is only about 2 months away. 2 months, which is hard to believe. This will be held again in Las Vegas. I will be there. Try not to gamble all of my money away on the NCAA tournament. Give us a sneak preview.
Yeah, well, so you're also going to be on stage. Let's call that out. You're one of our stars that's going to be on stage within the educational side of things with some of our peers within the industry. Elizabeth Kashner and Todd Sohn are going to be as well. I'm excited with some of the announced speakers that we have. SEC Commissioner Hester Peirce, I should say it the right way. SEC Commissioner Hester Peirce is going to be on stage being interviewed by no other than our friend Eric Balchunas. We're going to have Jan Van Eck on stage. We're going to have Jeff Sherman from Double Line on stage. Bob Pisani is going to be there, even though he's no longer with CNBC. He's going to be speaking on his own, and then he's also going to be interviewing Kara Swisher, which I'm super excited about that conversation. We already have more than 500 advisors that are signed up, a faster pace to getting to 500 advisors signed up than we did last year, which is really exciting to me and to the team at VettaFi. We've got some great partners that are set up to be there, some great experiences for people as well. You mentioned registration can still be done visiting exchangeetf.com, or reach out to me if you've got questions about how you or your firm can be a part of the event.
Well, Todd, I cannot wait for Exchange. That'll be a nice touch point, actually, for us to check in on these topics that we covered here today. We'll have to see what else pops up between now and then as well. But VettaFi always puts on such an excellent show, so I'm really excited about that, and I'm sure it's going to be another exciting year for the ETF industry. So again, very glad to kick that off with you here on ETF Prime. Thank you for joining me this week.
It's a pleasure. Again, Happy New Year, and thanks for the partnership.
That was Todd Rosenbluth, Head of Research at VettaFi.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Cullen Roche, founder and chief investment officer of Disciplined Funds, who just today, Cullen is out with a brand new book. It's titled Your Perfect Portfolio, The Ultimate Guide to Using the World's Most Powerful Investing Strategies. This is actually Cullen's second book after he wrote Pragmatic Capitalism a number of years back. And then not only that, this past November, Disciplined Funds launched a suite of what are called Defined Duration ETFs. So these are diversified, time-based investment strategies, which we'll get into exactly what this means. Cullen is now joining me from New York, where he's on a media tour. Cullen, I've got to tell you, you might be the first person I've ever had on here that finished writing a book and launched a new ETF lineup at the same time. I hope you actually enjoyed some downtime over the holidays.
I did not. I mean, it was somewhat strategic in the sense that in 2025, I kind of just loaded everything onto my plate because I was, kind of in this big push to, building the strategies for the ETFs, and then writing the book kind of went hand in hand. And so I happened to just sort of, push both out at the same time. But yeah, no, it's been a fun, busy year. I actually, I've been using AI for a ton of stuff. So it's crazy how much the world has changed just in my little world in the last 12 months. Because a year ago, I was thinking about hiring software engineers and new financial planners. And all of a sudden, almost like overnight, I could write code, and the 10% or so of the, let's say, financial planning things that are sort of nuanced that I don't understand, I suddenly feel like I have full access to. So it's been a really crazy 12 months in a lot of different ways.
Which is more stressful or difficult in your mind, writing a book or launching ETFs?
They're very different. The ETF world is bizarre because you need assets and momentum to make funds work, to make them viable in the long run. And you know that going into it, but you can't get the assets and the momentum without a huge amount of help. And, if you don't already have some momentum built into place. And so there's kind of this catch-22 with ETFs that makes them sort of really difficult to manage and, get to a point where you actually get the altitude to make them viable. And in a lot of ways, so it ends up being almost like venture capital. And in fact, I actually think of the ETF business as being more, akin to venture capital, even though a lot of the times they're pre-funded and whatnot. But it takes time for the momentum to build up. And so I think if you don't know that going in, the ETF business is just really stressful to operate because it just takes so long to get in, get competitive. And then you're fighting with, Eric Balchunas, our friend, calls it the terror dome. Which you're fighting with like the biggest, most powerful entities in all of finance, in Vanguard and Goldman Sachs and JP Morgan and BlackRock. And so, especially being a boutique firm like ours is, it's hard. Whereas writing a book, is a totally different process where it's, the funniest part about writing a book actually is that you have to read your own book like 300 or 400 times. And by the time you get to that 400th read, you're like, oh my God, I hate this person. I hate reading this book. And because you're going through and looking for like minor details, like, did I punctuate everything correctly? And you have to read it very carefully. It takes forever. So it's just a process, and it helps to have, I was lucky to work with Harriman House and, some great editors there. So, that helps a lot, but they're very, very different processes.
Well, I greatly applaud you on both. Believe it or not, over the years, I've actually thought about launching an ETF, and I've never taken the leap. And so I've taken the easy way out and just decided to cover the space. And then a fun fact for you, I actually started the process of writing a book on ETFs. This was years back. And to be quite honest, I just gave up going through it. I didn't have it in me to bring it to fruition. And so I will applaud you for taking on both of these endeavors. So let's talk about the book, which I actually have here. So this is, again, titled Your Perfect Portfolio, The Ultimate Guide to Using the World's Most Powerful Investing Strategies. I did have an opportunity to read this over the weekend. Greatly enjoyed the book overall. I have a few thoughts on that if you're interested. But, as we were just talking about sort of tongue in cheek, writing a book is obviously a huge undertaking. And I think there has to be a lot of passion around whatever you're writing about in order to actually bring a book to fruition. And so I'm just curious, what was that passion for you? Like ultimately, what was the motivation to write this book? I think it's Jason Zweig at the Wall Street Journal who I've heard him talk about, like it has to be like fighting to get out of your chest to tell the world something if you're going to write a book. So what was that for you?
Yeah, well, it's weird. I mean, my whole career has really revolved around traversing both the world of portfolio management and financial advisory. And so it's strange running your own RIA, your investment advisory firm, when you wear the hat of portfolio manager and sort of like lead advisor. And what I've found over time is that in a lot of ways, like these worlds, they almost like butt heads. The investment managers want high fees, they want to sell high performance, and financial advisors, for the most part, they don't really care about that sort of stuff. They want to make sure that their clients have enough money at certain times during their lives. And of course, the portfolio management process in all of this matters a lot, but high performance, generating really high fees is not necessarily a goal of a financial advisor. It's generating the right types of returns for the right types of clients. And so, I've always struggled with the best way to build portfolios. And, it just over the course of my career, it's dawned on me that everybody's different. And some people want the really high risk, they want the really high returns, and other people, they want something really conservative. They just, they've made their nest egg. They want to make sure that it's not going to blow up again in a 2008 or, a COVID type of environment. And, they're cool with something like 3 or 4% returns for the rest of, eternity. And everyone's different. And so that's kind of the gist of the book really, is that there is no perfect portfolio. So, I very intentionally titled it Your Perfect Portfolio because it's kind of an exploration of different portfolio types and different strategies. And the overarching goal is to help people sort of narrow things down to a point where they can then understand, okay, this is something that might work for me. This might work in this part of my retirement account. This might work in my taxable account. And understanding lots of different strategies, because I think that's one of the things that I've just spent an egregious amount of time understanding portfolio theory and different types of portfolios to the point where I was able to comfortably write about, a ton of different sort of famous strategies in I think a relatively articulate way. And then most importantly, narrow them down to a way where people can actually implement these. So I show people not only kind of the history of the strategy, where this thing came from and how it works, the pros and the cons, but I also show people, hey, this is exactly how I would implement this, or how you could consider implementing it for yourself.
Yeah, you walk through 20 or 25 different investment strategies in this book. And to your point, I think what I loved about this book is that its core concept is something that I actually talk a lot about, which is that you can have the best investment strategy, or you can hire the best investment manager in the world, but it doesn't matter if you can't stick with a strategy or you can't stick with a manager, right? It always comes back to investor behavior. And so I love that you focused on that. I guess talk a little bit more about that. I feel like, in my mind, that might be the single most important aspect of investing is just that, being able to stick with whatever strategy you choose.
It totally is, and you have to find a strategy that works. Sticking with a crummy strategy forever is obviously not a good approach. But no, I interviewed William Bernstein for one of the chapters, and William is a neurologist who he kind of has built a bunch of famous portfolios on his own. And one of them is called the no-brainer strategy, which weirdly, the no-brainer you find online is not the no-brainer that Bill actually likes. And so I kind of pulled that out of him. I teased it out of him in an interview. And then I had to kind of cobble it together on my own, because he's very clear that he's like, I don't believe in one broad strategy. I have a framework for building this. But he had this great line where he said that the suboptimal portfolio that you can't stick with that the suboptimal portfolio you can stick with will always perform better than the optimal portfolio that you can't stick with. And he's basically saying there that, if you have this theoretical optimal portfolio, that exposes you to all sorts of behavioral biases throughout time, you're going to eventually abandon it. And when you do that, it'll likely be at the very worst time or near the worst time. And you'll have ended up actually performing worse than if you had just had something you were comfortable with that was a theoretically sort of suboptimal portfolio. So, it's one of these things where the grass always looks greener. And in portfolio management, when the grass gets brown, people tend not to just stick with it and water their own lawn. They tend to think, oh, I'll just abandon this yard. I'll move across to my neighbor's yard where the grass is green. And then they find out 6 months later that grass is turning brown. And it's like, in a lot of ways, I think that's what people do throughout their financial lives is they hop from portfolio to portfolio, chasing performance. And it's all, a lot of it's just up here. It's in our heads. And this, I write a whole section on how we're our own worst enemy. And in a lot of ways, that's totally true because we're constantly exposing ourselves to these biases that will make us question everything at the worst possible times and potentially abandon a strategy that in the long run, if you just stick with it, will be good. So you gotta, it's like anything that's worth doing in life, really. It's going to be hard. The analogy I use in the book a lot is finding a spouse, and anyone who's been married a long time knows that, it stinks at times. It gets rough. You get in fights and you have to work through it. And, there's going to be ups and downs, but sticking with it when you've found something that you really love, will benefit you better in the long run than trying to constantly, jump from girlfriend to girlfriend to girlfriend to girlfriend.
Well, and just to give people a flavor here, again, you cover over 20 different investment strategies here. Two that you highlighted, one was the Boglehead 3-fund portfolio, and then you also talked about the trend following portfolio. And the way that I would frame both of these, so on the Boglehead 3-fund portfolio, that's basically you're allocating like a third to aggregate bonds, a third to total US stocks, and then a third to international stocks, right? Great if you look at the performance, Sharpe ratio, all of that going back over a long period of time. Excellent. The problem is, can people stick with it behaviorally because it's so simple, right? So that's an example. Or are you going to want to tinker because you don't want to own just say 3 ETFs?
Yeah,
and then if we look at say,
simple.
Yeah, it's almost too simple. And then on the trend following portfolio, I'll tell you firsthand. So at my advisory firm, we had a strategy where we implemented a trend following strategy. We basically overlaid that on the equity portfolios. And if you go back, you've seen all the back testing on trend following. I would sit here and tell you that it absolutely works. And it's excellent behaviorally because you can prevent those large drawdowns in equities. Here's the problem. You get whipsaw in trend following, right? Or you get, you're going to have periods where it lags just because maybe you're, yeah.
Periods.
And so I just thought those both were great examples of what you're trying to highlight here. And that, those are really two completely different strategies. One very simplistic,
super different.
Yeah. So talk about that because I thought those were perfect.
It was cool. Taylor Larimore was someone else who I interviewed, and Taylor is sort of like John Bogle called him the king of the Bogleheads, basically. And Taylor was someone who he wasn't even in the financial services industry, really. He served in World War II, and he had a wife. He lived in Miami, and apparently had a beautiful wife who was like the highest earning model in Miami at the time. And so he comes into all this money and he doesn't know what to do with it. And he starts emailing John Bogle, and they go back and forth over the course of years. They become great, great friends. And Taylor, sort of whittles down the whole Bogle mentality into this incredibly simple three-fund approach. And his goal was really to sort of, I think, distill Bogle into its like purest form of, how simple can we make this without it being counterproductive? And the 3-fund, he actually started it originally as a 4-fund portfolio. It used to have a cash component. I think as interest rates went down, he switched it. I don't think he regrets that now, but I've seen people on the Boglehead forum at times sort of question it. And it's one of the cons that I mentioned in the strategy is that, especially in the last 3 or 4 years, I think people have really started to question bond aggregates. I oftentimes criticize bond aggregates, which, might be tinkering or, kind of nitpicking in some ways, but there are valid criticisms, I think. And part of it is that this is something that for most people, I think, not, I shouldn't say most, but for a lot of people, they'll look at it and they'll say, this is just too simple, kind of 3 buckets. It's really 2 buckets. It's basically just a global stock component and then a bond aggregate. And I think a lot of people will look at that and just sort of say, oh, I wish I was doing some factor tilting, or I wish I owned more cash, or, something that was sort of, maybe making the portfolio a little more tax efficient. And then you've got, of course, the big potential error inside of something like this is that you've got really a lot of correlation inside of those instruments at the same time. And so you see this in a really raw sense in a year like 2022, when the bond aggregate goes down, 15% or so in a year like 2022, and stocks go down, and you get this, hyper correlation in certain environments where then you wish you had something like trend following, which is totally uncorrelated. And trend following was, I think, especially sort of cool to study in the book. First of all, because I know I'm childhood friends with Mike Covell, who's kind of the guy that Mike made trend following sort of what it is, I think. Or he's sort of been like the leading brand ambassador for the strategy in a lot of ways. And I remember he handed me a copy of his first book. This is probably, I'm ancient now, so this was like 25 years ago or something.
I've read that book.
And I remember him handing it to me, and I was like, this is so, I've never heard of this stuff. And he's writing about all these really famous guys like John W. Henry and Bill Dunn, and people that have made just crazy amounts of money running this really strange sort of strategy that is it's sort of momentum like, but it's not like the momentum factor like in a Fama French sense. And so it's very, very different. And this is the cool thing about trend following, was that it is one of the truly like fully uncorrelated strategies that you can find in the investing world, because it's strange. It's really hard to find truly uncorrelated strategies. And that's one of the things that trend following achieves really well. And so I think, especially after a year like 2022, when you see that bonds maybe they're not hedging everything as well as people had hoped, you get these acute periods where things like trend following and more really uncorrelated alternatives, have become much more persuasive inside of a portfolio. So, but again, it's like you said, trend following will test you behaviorally also, because it can go through, it'll really get whipsawed. Sometimes you could be up 100% in a year, and you could be down, 50, 60, 70% in a year. And in the long run, you have this nice, long, uncorrelated return stream. But, that road to getting there can be really bumpy, and it can be really flat. Like from 2010 to 2018, trend following did nothing. It was just a sleeper for almost a decade. And, 5-10 years of lagging or sideways performance will test anybody behaviorally.
Well, and it's funny because, as following the global financial crisis, that's when a lot of these trend following strategies actually sprung up, right? Following that, people go, oh, I better have some sort of mechanism in place to prevent a 40% drawdown or whatever. And so you saw all of these people implementing these trend following strategies that then went on to not work very well over the, the next decade or so. But this was a great read. Highly recommend everybody check this out. Again, Your Perfect Portfolio. So is the best place for people to go for this book, Cullen, Amazon, or is there another place?
Yeah, Amazon. Macmillan and Harriman House are the publishing, so you can buy it direct there. But yeah, Amazon's obviously going to be the place. Barnes and Nobles, if you want to pick up if you're old school, you like to walk into a bookstore and actually go in and pick up a book. They're in the physical stores too. So.
All right. Well, again, everybody check that out. I do want to ask you about this new suite of ETFs that you launched in November, if we can spend a few minutes on that. So these are called Defined Duration ETFs. There are 3 of these in all. So these cover 5, 10, and 20-year time horizons. I guess first, do you want to explain what defined duration investing is just at a high level, and then we can talk about the ETFs?
Yeah, so what I'm really trying to do is, following the financial crisis, I worked with banks on what's called asset liability matching portfolios. And banks have, if anyone remembers the Silicon Valley Bank failure, what happened with Silicon Valley Bank is basically they were over leveraged to long duration assets. And so they had an asset liability mismatch. And after working with banks, I realized that, hey, all of my retail clients have this exact same problem. They all have an asset liability mismatch. We're all trying to fund expenses in the future with our current existing assets. And a lot of the times what happens behaviorally with people is when the stock market scares you, what's really happening is that you're realizing that you have an asset liability mismatch. You're realizing you actually don't have enough cash in your portfolio, basically, or you don't have enough safe assets to keep you comfortable. So your portfolio is over leveraged to long duration assets. And so what I've tried to do with the defined duration process is I've actually tried to quantify what is the duration of different assets. And what I'm really doing inside of this is I'm trying to build a time horizon over which we can reasonably expect an instrument to generate real returns. And so I'm actually assuming some sort of like a break even point, essentially. So you're assuming a sort of a max drawdown, and you're then assuming an expected return and inflation rate, and then assuming sort of trying to predict sort of what is the time horizon over which, say, the stock market might generate a real return. And so if the stock market were to fall, say, 50% from here and was expected to generate a real return of, let's say, like 5%, the defined duration of that is roughly like 18 years. That's kind of like the break even point that it would take in real terms for that instrument. And so from a financial planning perspective, this is what's called sequence of returns risk. Basically, it's the sequence of which an instrument might expose you to an extreme sort of tail risk event. And it gives you, my main goal basically with this was to give people perspective of a time horizon over which to judge what is a reasonable time horizon to judge the stock market. And the general goal, basically, or the general conclusion, is that the stock market is generally like a 15 to 20 year instrument. That's like the average defined duration of the global stock market. And that puts into very clear terms how long of a time horizon can I actually wait to judge this instrument and its potential sequence of returns. And you can run this on various different instruments, and it actually, it kind of, the helpful thing about this methodology is it helps you build sort of a bond laddering like asset portfolio where you're actually implementing the stock market inside of it. And the stock market ends up being this very, very long duration instrument inside of the portfolio where you're kind of layering on a series of sort of time weighted instruments that can then be matched to specific financial goals. And so, the stock market inside of this sort of methodology can be blended with different assets. And then we actually constructed the ETFs in a way where we're blending these assets to match certain time horizons. And so the funds are time weighted in the sense that they're actually targeting a specific sequence risk over a very specific time horizon of 5, 10, and 20 years. And so you can build sort of like a planning-based portfolio where you're then matching specific assets to certain liabilities across specific time horizons. And you kind of know, okay, there's a very high probability that this fund on a rolling 5-year basis will generate a positive real return. This fund will generate a high probability of a positive real return over 10 years and 20 years. And you can build this into a financial planning process where you can then communicate the time horizons very clearly to clients. And that's really that was the main goal for me, was that I'm trying to solve a problem that I have in my own planning practice where I have a lot of trouble communicating the time horizon of different instruments to clients, especially when it comes to utilizing like traditional asset liability matching strategies. They typically use long duration bonds. Then that's in addition to being a really hard sell to clients, I actually think long duration bonds they're terrible liability matching assets, because in the long run, mathematically, if you've got 10, 15, 20 years, the probability of the stock market or even like a boring 60-40 portfolio beating that instrument is very high. And so locking somebody into this low yielding, very low real return yielding type of portfolio that still has a relatively high amount of volatility, it didn't make a lot of sense. And so embedding the stock market into this methodology in some sort of more systematic way was sort of the nut that I was trying to crack with all of this. And, I think I kind of have built the portfolios in a way where we're able to then say match a 10-year liability to a 10-year asset, but we're not just going out and buying something like a boring 10-year treasury note. Instead, we're building something that is functionally like it's a blend of different durations, because we're utilizing a mix of, say, short duration bonds with equities, blending them in a very specific way where we're not taking too much equity market risk inside of the instrument, but still generating what is likely to be a very high probability real return over a target 10-year period. And so in doing so, I think we're able to push people into the stock market a little more, especially in the longer duration stuff, without having to fill liability matching portfolios with nothing but bonds.
Yeah. So an example of an ETF is the Defined Duration 10 ETF, ticker DDX. Do you want to just talk a little bit more about what's actually going on underneath the hood here? If somebody were to look through what's in this ETF.
Yeah, so a good example to understand this is that what happens inside of any multi-asset ETF, like say, take a 60-40 portfolio, what happens inside of that thing is that the duration actually skews over time. And what I mean by that is that in the 40% piece, first of all, the actual literal modified duration of the bonds inside of that component has changed, in large part because the aggregate bond market is just eating duration, because the US government is issuing longer and longer bonds. And so they're forcing duration on the market all the time. And so if you buy something like the Boglehead 3 fund portfolio, you're eating longer and longer duration inside of that aggregate bond fund that you hold. And so the duration skews because of that. But also inside of the stock piece, when valuations get longer and expected returns go down, the defined duration, the way we quantify it, goes up. So for instance, in today's environment, something like the US stock market has a much higher defined duration than something like foreign stocks or domestic value. It's exposing you to more potential sequence risk. And, I'm not necessarily even saying that the US stock market will perform worse. It's just that when valuations are high, typically the risk adjusted future returns are lower. And so you're exposed to more sequence risk inside of that instrument, which means that when valuations are like they are today, the 60-40 of today is not the same as the 60-40 of, say, 2018, because the durations inside of both the 60 and the 40 piece have skewed. And so what something like DDX does is, rather than letting the duration skew, it offsets it. It actually rebalances back to a target weight duration, where it'll look at the bond component and say, okay, the modified duration of the bond component has changed from, let's say, 4 years to 6 years. Well, our target to get to 10 years, it has to be lower, because the defined duration in the stock piece is going to be, say, let's just say it's 18 on average. And so to get to an average of 10, you have to be much actually shorter on the bonds. And so you might own nothing but, say a 2 to 4 year bond portfolio, and then you're overweighting that component. And let's say you're like, at present, we're like 35% in the equity market. And when you blend all that together, you can then hit that 10-year target. So rather than letting the time weighting skew, we're actually rebalancing it back to this specific time weighted target. And so it's trying to maintain a more consistent sort of sequence of return risk exposure inside the portfolio, where you don't get this skew where like in the bond aggregate, where the duration can just skew based on issuance, or, in a market cap weighted stock ETF, what I would call the defined duration is skewing over time, because it's growing and expanding and contracting based on what the market does. And so this is a methodology where we're trying to sort of rebalance in what I call sort of like a counter-cyclical way, where that counter-cyclical rebalancing is rebalancing it back to a consistent and more constant maturity type of profile, than just allowing it to just whipsaw all over the place, which exacerbates a lot of the behavioral biases that people experience as they're navigating the financial world.
No, I think it makes perfect sense. I mean, at a very simple level, the way I describe this is that when stock valuations are elevated, obviously you're going to reduce stock exposure a bit. And when there's more significant interest rate risk, you're going to shorten up that bond duration. So I think if you just think about it like that in a nutshell, that'll help frame it. And then to your point, aligning the different time horizons by looking at the duration of whatever your underlying portfolio is.
It tries to get people to think in time horizons, where, like, to your example there, the stock market today, if you want if you have like let's just say you have like a 30-year time horizon. Well, I would actually say that something like that, you should be really aggressive. You should be in the longest duration instruments you probably can. You probably should own a ton of technology, a ton of AI. But if you're someone who's really time sensitive, let's say that you've got like a 10-year time horizon on certain instruments, you're approaching retirement or something like that, you probably are much, much more sensitive to AI exposure, to the Mag 7 exposure. And when you think of things in these time horizons, I think it sets expectations a little better, where you can then calibrate a portfolio to match your own behavior and your own expenses and needs over time, where you're not necessarily just owning whatever the market owns and then potentially whipsawing yourself all along the way.
Well, I thought these were certainly unique launches. I always love when I see innovative approaches come out in the ETF wrapper. So congratulations on launching these. Congratulations on the book. Again, highly recommend everybody check this out. It's titled Your Perfect Portfolio. As Cullen mentioned, you can find that on Amazon. Cullen, this is shaping up to be a pretty big year for you. You're already off to a nice start here, just a week into the new year. So best of luck to you. And
I've been in New York for one day and I'm already exhausted. So,
well, thank you. This was fun. That was Cullen Roche, founder and chief investment officer of Discipline Funds. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. I have an excellent show for you next week. I will be joined by Astoria's John Davi. So he's going to walk through his 10 ETFs for 2026. And then I'll also be joined by both Vanguard's Ryan Barkstill and Wellington's Kim Gallen to talk about the recently launched active equity ETFs. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.